Hi everyone and welcome to Swissquote's Daily Market Talk. We are Friday, January 23rd. The broader stress across global financial markets that was partly caused by the Greenland tensions and partly by the Japanese bond sell-off that we saw at the start of this week, maybe easing to the end of this week, but risk appetite struggles to return fully and gold is shining brighter than ever this morning. We are just at a spitting distance from the $5,000 per ounce level. The latter means that investors' confidence may be harder to regain this time around. Or not, we will see, but for now, we don't see the same enthusiasm among global investors, especially among global bulls, than the latest taco trade last year. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own, and this is not financial advice.
This show is brought to you by Swissquote.
So it took the US president a single minute to reverse the sentiment from fear to greed, but that wasn't really the greed that we were looking for. That was Wednesday's Davos speech. Still remember when the US president said that he's not considering a military action to take Greenland by force, even though he could, and that he and the NATO allies discussed about Greenland and came to a framework that deserved rolling back the latest tariffs that he imposed on a handful of European countries. A relief rally followed, as I said, but it didn't last long as we are entering the second year of Trump administration now. It is pretty clear to everyone at this point, and even to those who still had a doubt before last week, that the deals and the agreements that are made with the US government don't guarantee stability. They don't mean much because new tariffs could fall anytime, and they could be as big as the US geopolitical and trade ambitions, whether they make sense, whether they're legal, and whether the rest of the world, allies or trade partners agree with them. So the broad understanding of the risk today probably cast shadow on yesterday's relief rally. The S&P 500 gained, but gained less than 1% yesterday and remains below the weekly opening levels right now. Same is true for Nasdaq 100 index. Gold, on the other hand, spiked past the $49.50 per ounce level this morning in Asia, and it looks like we'll be hitting that $5,000 psychological mark before we thought. And that move is a clear sign that the risk appetite among global investors is not fully restored this time around. Among the technology stocks, Nvidia also failed to extend gains by a big margin yesterday. We see these days appetite above the 50-day moving average level that currently stands a touch below the $185 per share mark remains quite limited. Even CEO Jensen Huang saying that the AI adoption will require multiple more trillions worth of investment, and OpenAI Sam Altman looking to secure 50 more billion US dollar funding from the Middle East countries that will obviously partially end in Nvidia's pockets because they will be the one providing the GPUs for the new infrastructure among others. Well, couldn't whet investors' appetite this week. At least not in the big names, because the fresh news mostly boosts appetite in what we used to call the boring tech. In short, those are memory chip makers that anyone barely pronounced the name until last quarter of last year. But alas, these are the companies that are amassing big inflows right now. And how big? SanDisk, for example, is up by more than 1,000% since last August. Western Digital is up by more than 250%. And in the same series, Micron, that made a few headlines, so you might know the name, is up by more than 245% during the same period since last August. And this is because there is a memory chip shortage in the making right now. That's obviously aggravated by the rising needs of AI infrastructure. And although the memory chip market is characterized by boom and bust cycles, well, there is a consensus this time around that this is a structural shift, and that the latest boom that we see in the cycle, the one that we are just in, well, could be a longer and a more memorable one. Looking a bit deeper, with such a price rally, well, you obviously see valuations explode as well. SanDisk, for example, today trades with a P/E ratio of about 720. It trades 720 times its earnings. This will probably come down with exploding demand for memory chips and their capacity to raise memory chip prices that will boost their revenue. And once the revenue and earnings catch up, well, this ratio will come back to more reasonable levels. But 720 still looks like we might be in a bubble zone because memory chip making is still capital intensive and there are still capacity constraints that will be in play. The pricing power is sure the biggest bonus here, and the fact that this boom cycle is expected to last longer than the previous ones is a reason to price in higher future revenues for a longer period of time. But at the current prices and following such a strong rally since last quarter of last year, it is reasonable to expect a certain pullback. Maybe that would be an opportunity to jump in. Now, last word regarding the space, Intel, which gained 11%, remember, on Wednesday on the Greenland relief, well, lost 11% in the after-hours trading yesterday as earnings announced after the bell didn't meet expectations. The company announced a net loss of $600 million. That's 12 cents per diluted share, if you will, some 6 times the $100 million loss or 3 cents per share loss printed a year earlier. And if that's not enough, well, they gave a soft guidance for the current quarter as well, citing that they don't have the supply that they need for seasonal demand, and that supply would improve in the second quarter of this year. Now, there's still hope that Intel will benefit from the strong AI demand at some point down the road, if nothing from the US government support. But when will that demand arrive and help Intel do better is yet to be seen. Now, zooming out, all this AI investment translates into a stronger US growth. According to the latest GDP update released yesterday in the US economy grew 4.4% in the third quarter of last year, up from 3.8% printed a quarter earlier and surpassing the consensus of analyst expectations at 4.3% on a Bloomberg survey. The price pressures increased as well. The core PC prices rose from 2.6% to 2.9%, but that was rather matching the market expectations. It's been a while we haven't talked about the Federal Reserve and the Fed expectations, but the strong US growth and above target inflation in the US, though easing, have been decreasing the probability of a rate cut from the Federal Reserve in the coming months. Activity on Fed funds futures suggests today that the chance of a March rate cut fell to around 16% from around 50% when the year started. The US 2-year yield spiked past the 3.60% level yesterday for the first time in more than 6 weeks, and the 10-year yield stabilized after falling to around 4.25%. Now, note that the soaring stress in the JGB markets was also a reason, and it's easing, and that was basically on Takaichi's expansive fiscal ambitions, remember? Well, those are cooling as we're approaching the end of a very hectic week, but the reality is that Takaichi's fresh fiscal ideas, like dropping the consumption tax on food to 0 for 2 years as part of her campaign platform ahead of snap election that is scheduled for February 8th, is something that the Japanese cannot necessarily afford with a national debt sitting near 215% level. It would cost them an extra 5 trillion yen per year, and that's roughly $30 billion. What's more disquieting is Takaichi has so far not even outlined a clear financing plan for this. Does Takaichi remind you of someone else? Another lady in Britain a few years ago. And the cherry on top, the Bank of Japan is no longer buying the bonds that it used to. Why should you care? You should care because the Japanese are among the biggest buyers of US treasuries right now. And as the gap between the US and Japanese returns decrease, the incentive for the Japanese investors to repatriate their funds back to Japan increases. And the latter could vacuum liquidity out of the global financial system and trigger a market sell-off. This is a risk that surfaced a couple of times last year, remember, without, however, materializing, certainly because there is enough liquidity in the system right now to counter the Japanese repatriation. But for how long? Time will tell. So this is all for this hectic week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, and also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.